Welcome to the deep dive. Today we're cutting through the noise, really getting into the weeds of what's driving the crypto market. It's September 21st, 2025, and things are complex. Our mission is to synthesize quickly but thoroughly the three big things everyone's talking about. First, the Fed's monetary policy, always a factor. Second, huge regulatory shifts in the U.S., especially for stablecoins and ETFs. And third, this really crucial question, are we hitting the final, maybe explosive stage of this growth cycle?
It's a fascinating mix, isn't it? You've got these huge macro forces like the Fed influencing global liquidity that hits everything, but then you have these very specific U.S. regulatory moves that could, well, potentially unlock massive institutional capital.
So risk and opportunity living side by side.
Exactly. You need to be careful short term, but definitely position for what might come next long term. It's a tricky balance right now.
Okay, let's start with the immediate pressure point, the macro picture. The Fed cut rates just this week, September 17th. Usually more liquidity, that's good for crypto, right?
No.
But things feel a bit choppy.
Well, yeah. More liquidity is generally bullish long term for assets like Bitcoin, no doubt. But the market's still sort of digesting why the cut happened now.
Right. What's the signal?
Exactly. A rate cut is good, but it also hints the Fed might be seeing some economic weakness, maybe reacting to something. So traders are asking, is this a one-off or the start of more cuts? That uncertainty, that's what creates the short-term volatility.
So the market's waiting for more clues, like the dot plot or speeches.
Precisely.
Yeah.
Until we get clearer forward guidance, the market's just churning, processing the news. We're in that digestion period.
And you can see that digestion reflected in sentiment, can't you? We always look at the fear and greed index. What's it telling us today?
Okay, so right now it's sitting at 49, bang on neutral.
Neutral, okay.
Which is interesting because it's up a tiny bit from yesterday's 48, but it's definitely down from 55 last week.
Yeah.
So we've pulled back from that greed territory we touched during the recent run-up.
So the index is basically showing caution. People got maybe a little ahead of themselves, and now they're pausing.
That's a good way to put it. And look, historically, that's important. When this index really pushes deep into greed, above 70, that often signals peak retail FOMO.
And that's often when you see a correction.
Often, yeah. It's a classic setup. So being neutral right now, arguably healthy. It suggests sentiment hasn't totally lost touch with reality, but you have to watch it daily.
Yeah, definitely. And this caution seems to fit with what some sources are suggesting about the broader market cycle. You mentioned this idea of a potential final acceleration stage. What does that actually look like? Sounds intense.
It can be. Look, if this cycle theory holds, this phase is less about steady fundamental growth and more about momentum chasing price discovery. It's fast.
And the volatility, where does that come from?
It's often driven by leverage. Retail traders, maybe smaller funds, trying to catch that rapid upward move. As prices shoot up quickly, liquidity can actually get thinner up there. So even small selling can trigger big liquidation.
Cascading liquidations.
Exactly. Leading to those sharp, sudden drops before maybe the next leg up. It's a, let's just say, a very risky environment for anyone using high leverage. Very risky.
Okay, so if the Fed sets the short-term rhythm, maybe the long-term boom, if it comes, is really about regulation. Let's pivot to that. Seems like U.S. regulation is the key driver everyone's focused on for the next, say, 6 to 12 months. Let's unpack this, starting with stablecoins. Big news there.
Huge news. The whole conversation around regulation has shifted. It's not if anymore, it's how. And that structure, that clarity, is what builds confidence. The centerpiece is the Genius Act.
The Genius Act.
And this isn't just about slapping on some rules. It's aiming to create proper, almost banking-like standards for stablecoin issuers. That's the goal.
What kind of standards are we talking about? What should people know?
The absolute core is the requirement for one-to-one reserve audits, real audits, and clear legal segregation of customer funds. Before, it was murky, right? Lots of speculation, FUD.
Fear, uncertainty, doubt.
Yeah, exactly. By demanding that kind of transparency, that bank-like approach to reserves, the act could transform stablecoins from being seen as this kind of risky crypto thing to potentially the safest, most efficient way to do digital payments, retail, cross-border, you name it.
And that clarity makes them the potential backbone of DeFi you mentioned.
That's the idea. If they're truly stable and trusted, they become the reliable settlement layer for everything else in decentralized finance.
Okay, Genius Act sounds potentially transformative. But we've heard about broader market structure bills for ages. Why does this legislative push feel different? Is there more urgency?
I think so. Part of it is just the frustration boiling over from institutions from the industry about the regulatory infighting, the lack of clarity. These market structure bills are vital because they aim to finally draw clear lines. Who regulates what? SEC, CFTC,
That old chestnut.
right? This ambiguity, it's led to years of regulation by enforcement. You only find out you broke a rule when you get sued. That has to stop for major players to feel comfortable coming in at scale.
And maybe crucially, there's a new face at the SEC, Paul Atkins, who seems to be signaling a different approach.
That's potentially a very big deal. Chair Atkins has actually talked about moving beyond just forcing digital assets into laws written decades ago for totally different markets.
Like the Howey test from the 1940s.
Exactly. His suggestion of creating custom rules specifically designed for digital assets, that's a radical departure. It signals a willingness to actually engage constructively. For institutions, that kind of signal is huge. It's the green light they've sort of been waiting for.
Okay, so pulling it all together, clearer rules for stablecoins via Genius, potential clarity on SEC, FTC jurisdiction, a more adaptable SEC leadership.
Yeah.
It all points towards smoothing the path for
Institutional adoption, that's the end game here.
right, better regulation, more clarity around things like ETFs and how assets are held that lets big corporations, traditional finance, step in with much more confidence. And we're already seeing hints of it, aren't we?
Yeah.
More public companies putting Bitcoin on the balance sheet.
We are. The appetite is there. It feels like the Genius Act and this potential shift at the SEC are finally starting to open the gates for that institutional capital.
Okay, so let's connect this sentiment and regulatory backdrop to what's happening right now, like the last 24, 48 hours. Let's look at the big two, Bitcoin, BTC. Well, sentiment is still pretty optimistic after hitting that new peak.
Holding strong.
Yeah, behaving more like a blue chip asset now. The expectation is maybe sideways trading, perhaps a slight drift higher. But like we said, it's still very sensitive to any whispers from the Fed, any FOMC speakers.
What's interesting, though, is the momentum we've seen recently in Ethereum. Percentage-wise, it's actually been outperforming Bitcoin lately. What's driving that?
Yeah, ETH has had a good run. It seems to be benefiting from two really solid catalysts right now. First, all this positive noise around stablecoin regulation, the Genius Act, that directly helps Ethereum.
How so? Because most stablecoins run on it. Precisely. Think about USDC, USDT. The vast majority are issued and settled on the Ethereum blockchain. So that sector gets regulated and grows. Ethereum is the primary settlement layer handling all that value. It's fundamental. And second, you've got the upcoming Pectra upgrade. This isn't just hype. It's a real technical improvement for the network.
What does Pectra actually do?
Primarily, it focuses on improving staking withdrawals, making it easier to unstake ETH, and making transaction fees, gas fees more efficient and predictable. These are practical upgrades that make Ethereum more usable, more attractive for developers, and they reinforce its deflationary aspects too.
So, real utility improvements combined with regulatory tailwinds. Makes sense. But there's a key price point we need to remember for ETH, isn't there?
Absolutely crucial detail. Despite this recent strength, Ethereum still hasn't broken its all-time high from back in 2021. Bitcoin has already done that.
So BTC is in price discovery, ETH isn't quite there yet.
Exactly. For ETH, getting decisively above that old peak is a major psychological and technical hurdle. Breaking it would really signal confirmation of a new cycle for Ethereum specifically.
Okay, this is where it gets interesting for the broader market, right? Altcoins. Capital doesn't just flow into BTC and ETH, it moves around. Which types of altcoins seem best positioned given everything we've discussed?
Yeah, the market definitely segregates. The sources are pretty clear on this. Follow the infrastructure. Tokens that are directly tied into DeFi and stablecoin infrastructure look set to benefit most.
Why them specifically?
Because if the Genius Act brings clarity and trust to stablecoins, their usage should explode. That means more volume on decentralized exchanges, more activity on lending platforms, more need for bridges between chains, anything that supports that stablecoin ecosystem. Assets linked to cross-chain settlement, yield generation on regulated stablecoins. That's the area to watch.
Infrastructure plays. And on the flip side, which altcoins are most at risk if the market, say, pulls back or gets choppy?
The risk is concentrated in the highly speculative stuff. Altcoins without clear utility, the ones running purely on narrative or hype. If this acceleration stage hits turbulence, or if institutions get cautious, capital will likely flee those riskier assets first.
Back to safety.
Back to perceived safety. Which brings us to a really key indicator for measuring that relative strength. Bitcoin dominance, or BTCD.
Right. What level are we seeing now, and what does it tell us about market structure?
Right now, it's sitting around 57.1%. That's quite high.
And high BTC dominance means?
It means capital is heavily concentrated in Bitcoin relative to altcoins. It's usually interpreted as a sign of caution, maybe even fear about the altcoin market. Traders are prioritizing Bitcoin, perhaps for capital preservation, rather than chasing higher risk, high reward plays elsewhere.
So what should listeners be watching for with BTCD?
You'd want to see a clear, sustained drop in Bitcoin dominance. Let's say it breaks convincingly below 55% and stays there. That could be the signal that risk appetite is returning, that capital is ready to flow more broadly into altcoins. That's your potential early sign of a true altcoin season. Until then, high BTCD suggests caution is still the dominant theme.
Okay, besides BTC dominance, there's another critical indicator, especially for tracking that institutional money we talked about, ETF flows. Why is looking at ETF data so important, maybe more so than just general exchange flows?
Yeah, that's a really good point. General exchange flows can be noisy, right? Could be retail moving coins, whales shuffling wallets, arbitrage bots, lots of things.
Hard to interpret sometimes.
Exactly. But ETF flows, these are regulated products managed by major institutions. The net flow data money coming in or going out is reported transparently. It's a much cleaner signal of what serious managed institutional capital is actually doing.
Got it. So consistent positive net flows into Bitcoin or Ethereum ETFs suggests strong institutional buying, supporting prices medium to long term. Negative flows mean they're selling.
Precisely. It's probably the clearest window we have into traditional finances conviction, or lack thereof, in this asset class right now.
Okay, so bringing this all together, potential final acceleration phase, regulatory shifts, institutional interest via ETFs, how should people be thinking about managing risk? And obviously, this isn't investment advice, just reflecting the source materials perspective.
Absolutely, not advice, but from a strategic perspective, given this potential for a volatile final acceleration stage, the sources strongly caution against high leverage. Things can move incredibly fast, 10% swings can happen in minutes, and leverage amplifies both gains and, more importantly, losses. Wiping out positions is a real risk.
So caution on leverage. What about strategy, given the positive regulatory signs?
The suggestion is diversification. Not just holding BTC and ETH, but thinking strategically about allocating to those other parts of the ecosystem. We mentioned the DeFi and stablecoin infrastructure plays that could directly benefit from things like the Genius Act passing.
Spreading the risk, but focusing on areas with potential regulatory tailwinds.
Kind of, yeah. And practically speaking, what should listeners be doing now to navigate potential volatility?
Like actionable steps.
Yeah. First, keep a very close eye on the legal news, especially any updates on the Genius Act that's a potential market mover. Second, basic risk management is non-negotiable. Using tools like stop-loss orders becomes critical in a potentially fast-moving market like this.
Protecting your downside.
It's priority number one. Don't get caught up chasing the last bit of a potential parabolic move with high leverage. Focus on preserving capital to play the longer game that regulation seems to be setting up. Hashtag tag outro.
Okay, that was a lot to unpack. As we wrap up this deep dive, let's quickly summarize the key things you should really be watching, say, starting tomorrow, September 22nd, to track these moving parts. First up, definitely listen for any speeches from FOMC members, their tone, their hints about the future path of interest rates after this week's cut. That's going to drive short-term sentiment and volatility.
Second, keep your ears open for any news out of the Senate regarding the Genius Act. Any signs of bipartisan progress, any scheduled debates or votes, that's probably the single biggest regulatory catalyst on the immediate horizon. Positive news there could really ignite things.
Good point. And third,
keep an eye on the big picture on-chain data. Specifically, watch for large flows of Bitcoin and Ethereum moving onto or off of exchanges. Big outflows often suggest long-term holding bullish. Big inflows could mean selling pressure is building bearish. It gives you a sense of whale and institutional positioning.
Right. So FOMC commentary, Genius Act progress, and on-chain flows.
Got it. And that brings us to a final thought, something for you to really chew on. We've talked a lot about the Genius Act and stablecoin regulation.
Yeah.
So here's the question. If this act passes, if it really does create that solid, audited, trustworthy foundation for stablecoins, does that finally unlock the door for DeFi protocols? The decentralized exchanges, the lending platforms. Will that regulatory clarity be the key that finally allows them to achieve real, significant institutional adoption, maybe defining the whole next market cycle? What really stands out to you about how that regulated foundation changes the entire landscape for DeFi?
Interesting question. From risky experiment to regulated infrastructure, what does that unlock? Something to definitely think about. Okay, that's our deep dive for today. Hopefully these insights help you navigate the market. Thanks for joining us. We'll talk to you next time.